remember our simple tax formula for individuals. Well, now here's our tax formula for corporations. And it follows along the tax return. So it's exactly how the tax return is laid out. Gross receipts minus cost of goods sold to get our gross profit. And then we add interest, dividends, capital gains, other types of income that aren't associated with whatever was included up at the top, right? To get our total income. Then we're going to subtract our ordinary necessary trade or business expenses. By the way, all the depreciation rules, you don't have to relearn them because it's all the same for corporations as it was for individuals. Subtract all of those ordinary necessary business expenses to get our taxable income before special deductions. Then we subtract any net operating loss deduction, which we'll talk about, and any dividends received deduction, which we'll look at in more detail, to get our taxable income. We multiply that by our applicable tax rates to get our tax liabilities. So, and just like with individuals, whatever we've already paid, or if we have tax credits, that's going to reduce the amount that we owe. If we have an overpayment, we get a refund. If we have an underpayment, we owe additional tax. Corporations do have to make estimated payments. There's no withholding for corporations, right? There's no paycheck to withhold from. They have to make those estimated payments. We also don't have this concept of adjusted gross income for corporations. Our adjusted gross income is really important for individuals because so many other factors are dependent upon what that number is. There is no adjusted gross income here for corporations. They're actually simpler than individuals. It's just that it's kind of a foreign concept to us. We're not as familiar with the activities of a corporation as we are with our own activities. What did I want to mention? There was something else I wanted to mention here. Oh, also, super easy, one tax rate. Corporations have a flat tax, 21%. That's it, 21%. There's no marginal tax brackets. There used to be, but when they passed the new tax law in 2017, that was one of the things that changed. The tax brackets for corporations used to range from 15% to 35%. Now it's just a flat 21% tax rate, which is awesome for those companies that were in the 35% tax bracket before. Maybe not quite so awesome for those companies that were in the 15% tax bracket before, right? But one tax rate, that's all you have to remember. And I'm going to emphasize that. It's 21%. In fact, I'm going to write it on the board. 21%. Why is she doing this? Oh, she must want us to remember this for some reason. I wonder what it is. 21% tax rate. That's it. Got that? What's the tax rate?
Never change.
Huh?
Never change.
Until they change the tax law. 21%. That makes it easy to calculate, right? Okay. So this is our basic calculation. Again, it follows the tax return. Well, it follows the first couple pages of the tax return anyway. Okay, so capital gains and losses. As I said, remember with individuals, we had to net all of those capital gains and losses because we had long-term capital gains, we had short-term capital gains. We could take that capital losses up to $3,000. There are all these complex rules. We don't have those with corporations. There is no long or short-term gain for corporations. It's all 21%. All the income is taxed at the same rate. What a concept, right? So, and there is no $3,000 or any amount that can be used to offset other income, okay? So what happens with those losses, because you could have a loss, what happens is they get to carry back any losses 3 years and then forward 5 years. First you go back 3, although you can elect not to go back. So if you had capital gains in previous years any of those 3 previous years, you can go back and amend those returns and claim any current year capital losses against those gains. For those 3 years, if you didn't have any or you don't want to go back, you can take it forward. Okay? So 3 preceding years, starting with the earliest year and then forward 5 years. So they can only use those amounts against net capital gains in the years. They can't use it to offset other income. It has to be capital gain income that they had. So here's an example. We've got ABC Company. It was formed in 2017. It had a gain. These are capital gains. 7,000, 10,000, 1,000, 5,000. So gains in all those years, and then boom, 2022. They had a $21,000 capital loss. What they would do is they would take, so they go back 3 years. So we would start, we can't go to 2018. That's 4 years. We'd start in 2019. We'd amend that return. We'd take $10,000 of that loss to offset that gain. We have 11,000 left. Then we could go back to 2020 next and use that $1,000 of that to amend that return. Now we've got 10,000 left. We go back to 2021. We can offset that $5,000 gain, so we're going to take 5,000 out of the 10,000 that's remaining. We've got 5,000 left that we can then use in future years. Okay?
Or you can return the 21 for, if you don't want to go back.
You can make an election not to go back and only go forward.
So if you don't.
But you don't skip. If you make an election to go back, you've got to. You go to the next. If there was no gain here though, you just go to next year. Yeah. So and then that remaining 5,000 they would carry forward. So here's another one. Pirate Company reported capital gains and losses of these amounts. So, what was the so here we've got 2 years with losses. So it gets a little bit more complicated. I'm going to erase this, but remember, 21%. 21. Not 22, not 20, 21. And it's on the video too, so if you need to, low battery, come on, man. It's still going. All right, so when you're doing this, you kind of have to, you might want to put like a table up, because I think you do have some problems along these lines. Bless you. So we've got 2017, 2018, 7,000, 2019, 10,000, 2020, 16,000 loss,
Yeah.
loss, and 2021, 5
Yeah.
gain,
Yes.
and then $14,000 loss. All right. So in 2017, we formed our corporation in 2017, so we don't have any place to carry this back. Right? We can only carry it forward. So what we're going to do is we're going to move that to 2018. So now we have a $5,000 gain. We had another $10,000 gain in 2019. Now we've got a $16,000 loss. We've got nothing in 2017, but we can use 5,000 of that here. So okay, got nothing left there. Here we've got 11,000 left. And then we can use 10,000 here. We've got $1,000 left. That will then carry forward to 2021. Those are both gain years, right? Oh, this was a loss. That $1,000, we can carry it forward to 2021, which leaves us with a $4,000 gain. $14,000 loss here. We can take 4,000 of that. $5,000 left that we'll use going forward. Okay, so, yeah,
Can you explain that again?
yes, you bet. Okay, so this is a 2, by the way. So, 2017, $2,000 loss, these are our original numbers. Yeah. Okay. First thing you wanna do, you wanna start at the beginning, right? And kind of put yourself in the position of being in 2017, here. You did your tax return, you got a $2,000 capital loss. You can't go back because you just formed your corporation. So you can only take that loss and go forward. Well, next year, you had a $7,000 gain. So we're gonna use that loss, apply it to the $7,000 gain. Now we are left with a $5,000 gain in 2018. When we're preparing our 2018 return, we're gonna pay tax on that $5,000 gain. But we're not gonna pay tax on the $7,000 because we used the $2,000 to offset it, okay? We get to 2019, and again, we have a $10,000 gain. So we have to pay tax on that as well at that point in 2019. Remember, 2018, we had 5,000. We haven't had another loss yet.
So once you carry forward the loss from 2017, does that make it like 0? Then, like how the other ones, when you like balanced it, it turned it to like 0 for like you took.
Yeah, okay, so 2,000.
Okay.
Okay. So there's 0 left there, 0, 0. And then this one, well, this is 1,000. I should put this here too so that it's 0. Yeah. Okay, so in 2018, we took that, paid tax on $5,000 gain. 2019, we had another gain of $10,000. So we had to pay tax on that. Well, in 2020, we had a $16,000 loss. So what we can do with that, we can't take the loss, but we can look back up to 3 years and amend our returns to lower our taxable income by the amount of capital gain we have. Well, if we look back, so we take 2020, we can go back to 2017, but we've got nothing left, right? We can't take anything for 2017, so we go to the next year. 2018, we had a $5,000 gain that we paid tax on. So we can take 5,000, that's that 5,000, of that $16,000 loss, amend the 2018 return so that we offset that $5,000 gain. Now we had no gain. It's like we had no gain. We'll get a refund for that year. After that, we've got $11,000 loss left because we used 5 of it. We can take 10 of that and apply it toward last year, which was a $10,000 gain. So again, we'll amend our tax return and we will get a $10,000 offset to the tax that we paid on that $10,000. But we absorbed 10,000, so this brings this down to 0, and we've only got 1,000 of that 16,000 left. That 1,000 is going to go to the next year, or the next year when we have a gain, as long as it's within 3 years. Because if say we had a gain, and a loss, that loss, we can't go all the way back to 2020 because it's too far. We can only go back 3 years. So in that case, we would have just lost that negative $1,000, right?
But even though we had the gains, because you said a gain, and then a loss. Or
Right.
you said 4 gains.
Well, and pretend we didn't have anything carried
Oh,
over
okay.
here. Yeah, sorry. Pretend this didn't happen. Yeah, pretend this was a gain, and then another gain, and then another gain, and we didn't get a loss. Then we wouldn't be able to come back and take it because it's too far in the past.
But could we do 22s? Because you said.
We
you said
can
3
do, well,
gains.
what we did was, in 2021, I'm sorry, I said that backwards. If we had a loss,
Okay.
and then a gain,
Okay.
you're right, because, so in 2021, we did have a gain. So like, if we did not have any more gains, we would just lose this.
Okay.
It's just off into the ether. Okay, so where was I? Okay, so the $1,000, we're left with $1,000 loss, or $1,000 capital loss that's just hanging out there, waiting for a gain so that it can offset it. Well, next year we have a gain of $5,000. So we're gonna use that $1,000 from last year, apply it to 2021. Now our gain is reduced down to $4,000. We'll pay tax on that, but then the next year, we have another loss. So we can go back again. So we have nothing, we have no losses, well, this is too far back anyway, but we have no losses left to absorb here. But we did have one here. Or I'm sorry, no gains to absorb in any of those years, but we do have 2021. So we'll take that 4,000 of that, go back and amend that tax return. That brings that down to 0. Now we can't go back anymore because all of these are at 0. We have no gains that we can offset anymore. We've already offset all of our gains. So even though we have this $10,000 loss this year, we'll have to use it going forward and hope that we have some capital gains at some point so that we can offset them with that 10,000. Does that help? Okay. But yeah,
What does it mean though when it's just waiting for a gain? Like we just have to, do we pay on that loss or does it just? sit
no,
there?
but it doesn't give you any benefit.
Right, okay.
There's no benefit from it until you have a gain to absorb it. And then there's a benefit. All right.
And then anything that's lost after so it's carry back of 3 years but carry forward of 5.
Mm-hmm.
And then anything that's not like absorbed is just gone after that?
Mhm.
Okay.
So as it said, you file an amended return for those prior years. So, also those tax rates, as I had mentioned, it's just 21, what's the tax rate?
21.
Thank you. What? All right, so a couple of other things that are different about, in fact, I'm gonna do this. That was 17 minutes.